Forex, or FX as it's also called, is the name given to foreign exchange. It's the buying and selling of currencies by investors and speculators, the market participants. It's the world's largest financial market with trillions of dollars worth of trades taking place every day. In comparison, the stock market has an average daily trade volume of about a fifth of the Forex market. As mentioned, the Forex market is the largest financial market in the world, and that's beneficial for those that trade it. Due to size and the sheer amount of buyers and sellers all contributing to the enormity of the Forex market, currency prices generally tend to fluctuate more than, for example, stock equities. These price fluctuations, or volatility as it's called, have the potential to offer traders more opportunities. In the short term, price fluctuations are, in part, affected by how market participants buy and sell a given currency. However, the price of a currency is heavily influenced by fiscal and monetary policies implemented by governments and central banks of a particular country. So let's explore Forex. When can you trade Forex? Forex is not traded on a single exchange, but is traded from bank to bank. This offers Forex traders the ability to trade around the clock during weekdays, as there's always a bank open somewhere in the world to facilitate a transaction. Forex is traded every weekday, 24 hours a day, during fixed opening hours for the banks facilitating the flow of currencies. As a result, a single day of 24 hours is divided into 4 sessions relating to where in the world the trading is taking place. In other words, when Europe is fast asleep, Forex trading is buzzing in Asia, and vice versa. A salesman is walking from door to door to offer up his product for sale. Each house he visits represents a potential trade opportunity. The salesman's total number of trade opportunities is directly related to how fast he's walking from door to door, as visiting more houses means more opportunities. Similarly, the pace in which the Forex market operates offers traders more trade opportunities. The Forex market is open 24 hours a day, 5 days a week. This makes it a good market for traders and investors with a busy schedule or day job. Let's revisit the analogy from before. The door-to-door salesman has picked up the pace and is visiting houses as fast as he can. However, the salesman's trade activities are restricted to the period of time during the day when people are at home to trade with, in much the same way as a stock exchange has fixed daily opening hours. This means that the salesman has very little flexibility during his day to maximize profit potential. This restriction does not apply to the Forex market, as it's traded around the clock. There are literally thousands of available stocks, all of which represent a different company, managed in a different way by different people with different products or services. With Forex trading, whilst there are many currencies available, the vast majority of trading is centred around 7 specific currencies. The simplicity offered by only having to know several of these currencies stands in contrast to active stock traders scouring available stocks in the hope of locating potential trade opportunities. When trading cash stocks, you're limited to buying only. As such, a trader can only express the sentiment that the stock stands to increase in value following the purchase. Trading Forex allows the trader to express both a negative and positive view towards a given currency. Do you believe the value of the dollar will go down? Sell it. Believe it will go up? Buy it. The point is that Forex traders have the opportunity to profit from both falling and rising markets. Leverage can be applied to a Forex investment. Leverage is the ability to increase your investment on underlying currency. For example, you place a trade with a leverage of 2 to 1. This means that for every 1% increase in the value of the US dollar, the value of your trade would increase with 2%. If you choose to apply the maximum available leverage of 50 to 1 and the dollar then subsequently rose by plus 2%, your investment will have doubled. After a 3% rise, your investment would have returned 150% of the original amount, and so on. So isn't leverage also dangerous? Yes. Just as leverage can send your profit soaring, if used unwisely, it can lead to a significant loss. In a scenario like the one above, where a 50 to 1 leverage has been applied to a trade, it would only require the currency to depreciate by minus 2% before the entire initial trade would reach minus 100%. At minus 3%, the loss would then exceed the initial trade allocation and reach minus 150%, and so on. While leverage is an appealing tool for aggressive investors, it should be applied with caution. You will learn much more about the mechanics of leverage and its appropriate application in a later course. Countries trade goods between one another continually. In order to trade goods, let's say a US buyer is looking to purchase goods from France, the buyer needs to convert dollars to euros, to buy euros in other words. If a country sees a high demand for its products or services, this places a demand on its currency and would typically increase its price. Conversely, countries or states that need to buy many goods on the international market would mean they have to sell their currency in order to buy others. This would typically reduce the value of their currency. Capital markets refers to the flow of money. It means the channeling of money from suppliers of capital to the users of capital. For example, banks and institutions supplying money to businesses and individuals for economic activities. Capital markets mean that an economy can function. Without capital, economic activity stalls and affects the country's overall economy. There are primary capital markets. These might be new stock or bond issues from companies or governments, and there are secondary capital markets. These markets are concerned with trading stocks and bonds on an ongoing basis. As capital markets are what define a country's economy, they have an effect on international trade. Therefore, this is a key driver of the currency market. GDP, employment, retail sales, trade deficits, interest rates, inflation. These economic reports are crucial for a forex trader to follow, as they act as a barometer to how an economy is performing. These figures are often released on predefined dates, and therefore an economic calendar is an essential part of the forex trader's toolkit. A country's overall economic policy is also something that affects its currency. On the one hand is fiscal policy, which defines budgets and spending on services. On the other hand, there's monetary policy. This is where a government central bank sets the supply of money, which in turn drives interest rates. Forex traders need to be aware of these key factors in order to define their trading strategies. A nation's currency can be defined by its political conditions. Regional and international political events can drive currency fluctuations for an individual currency or even that of a neighbouring state. Countries with a transparent democracy and sound fiscal policies will generally have a more reliable currency than countries with destabilised governments or weak financial structures. Exchange rates can therefore be a reflection of how a country's government and its fiscal policies are perceived. It's important for a forex trader to monitor political events and news in order to gauge how these might affect a country's economy. As custodians of a country's monetary policy, central banks attempt to control inflation levels and adjust interest rates to create better economic conditions for growth. By no means an easy task, and this also means that they command an unparalleled ability to manipulate their country's currency price rates. Financial institutions such as commercial banks serve the role of brokers on behalf of the clients they represent. Banks negotiate prices for significant amounts of money with other banks and then turn a profit by adding a markup to the price they originally paid. This is comparable to a product vendor buying in bulk to resell to its customers. Most business and corporations are not actively speculating in the price of currencies with the intention to turn a profit, but rather to limit risk. This is the case for most companies engaged in international business transactions. When a company buys or sells goods or services across borders, a currency exchange typically takes place in order for one party to receive financial compensation. Currency exchanges make up a significant percentage of the daily average traded volume for the Forex market. Hedge funds and wealth management institutions are privately owned organizations actively seeking to profit from speculative trading. By pooling funds from their respective investors, these market players have the ability to significantly affect the movements and direction of the markets they're engaged in. A scalper is an incredibly active trader who would look to make many trades during the day to turn an overall profit. Scalping requires high levels of control as trades are opened and closed within a few minutes or even seconds, and likewise with significant leverage. This type of trader will avoid news announcements as these events typically have wild swings and increased volatility. Scalpers also use leverage to a large degree in order to maximize the potential of their trades within short time periods. A day trader is also very active in the market and will often attempt to identify a potential trade opportunity as early in the day as possible and then allow the scenario to unfold over the course of the day. A day trader, as the name implies, is typically restricted to intraday trading, meaning that all open trades are closed at the end of the day. With this type of trade style, traders will look to place fewer trades, but in return expect each trade to make bigger gains and therefore allow more time for this to take place. Trades are typically held open for a few days, up to a couple of weeks. This style of trading is characterized by traders employing a very passive approach to investing. Only very few trades are placed, but in return held for extended periods of time, allowing for each trade to accumulate a more significant return. Trade durations vary from days to weeks and even months. Let's review what you've learned. Price rates in the Forex market are affected by international trade and flow of capital. Also, fiscal and monetary policies set in place by governments affect the economy of their respective countries. Market participants driving the market forces are central banks, businesses and corporations, as well as financial institutions. These are the most significant Forex market participants, based on their ability to affect the Forex price rates. Retail traders, scalpers, day traders, swing traders and position traders generally hold little sway over the Forex market. This is due to individual amounts traded being insignificant relative to institutional players. Retail traders seek to profit from price fluctuations created by market forces driven by larger market participants. While Forex trading is relatively straightforward, like any other financial instrument, it is essential that you have understood the concepts and the risks involved before entering into any trades.